Most people have so many flaws, too emotional, too greedy. They feel terrible if somebody's making money they're not making. So they rush into the market and they throw gasoline on the fire. You must abstain from that process. If you're part of that process, you'll perform as terribly as they do. But even better than abstaining is to sometimes do the opposite. And that's called contrarianism.
What if I told you it was possible to make $2.2 billion from a simple set of timeless investment principles? That is exactly what legendary investor Howard Marks has done. And no, he didn't come from a trust fund or have some one-in-a-million startup idea. Howard Marks grew up in a working-class family, but through following a simple, easy-to-understand set of investing principles, he was able to become a billionaire. In this video, Marks will teach you that exact secret formula. Make sure to stick around till the end of the video because we have a special reward for those of you who watch to the end of the video. Let's get into it.
So-called human nature, emotion, tends to conspire to make us do the wrong thing at the wrong time. When things are going well and the economy is rising and profits are reporting rising earnings and stocks are rising, people get more and more excited and they buy more and more and more at higher and higher prices. Then things peter out. The economy's not so great. The company news isn't so good. The prices are collapsing. Then they get depressed and they sell. Well, my mother told me, buy low, sell high. Human emotion tends to get you to buy high, sell low. So that's the essence of being countercyclical or contrarian. And most people have so many flaws, too emotional, too greedy. They feel terrible if somebody's making money they're not making. So they rush into the market and they throw gasoline on the fire. And if you can just, well, first of all, you must abstain from that process. If you're part of that process, you'll perform as terribly as they do. But even better than abstaining is to sometimes do the opposite. And that's called contrarianism.
Let's break down exactly what Howard Marks is telling us here because this idea is crucial to becoming a great investor. Marks explains something simple but important. Even though everyone knows you're supposed to buy low and sell high, most people end up doing the exact opposite. Why? It comes down to one thing: emotion. When prices rise and markets look strong, people around you get excited. It's human nature. When prices crash, people panic and sell at huge losses. Excitement and fear cause people to ignore logic and make expensive mistakes. Mark says great investors don't just avoid these emotional traps, they do the opposite. This approach is called contrarian investing. It means buying when others are afraid and selling when everyone else is greedy. For example, back in 2008 during the financial crisis, fear was everywhere. Investors dumped anything they thought was risky. But Howard Marks and his firm, Oaktree Capital, did the opposite. When everyone else was selling, they carefully bought investments others were too afraid to touch, like distressed debt from companies struggling to survive. Because everyone else was scared, prices were incredibly low. When the panic faded and the economy stabilized, these investments recovered and Marks made big profits by doing the opposite of what everyone else was doing. This lesson isn't just about history. It still matters today. Look at the big tech sell-off in 2022. Tech giants like Meta lost trillions of dollars in value in less than a year. Investors saw the collapse, read scary headlines saying, "Tech's best days are over," and sold in a panic, locking in massive losses. But here's the key. That widespread fear created huge opportunities for investors who could see past it. Let's focus on Meta. At its lowest point in November 2022, Meta stock had crashed from around $350 to just $90. The market thought the company was doomed. But under all that panic, Meta still had billions of active users, profitable core businesses, and plenty of cash in the bank. Smart investors who stayed calm saw incredible value at these prices. And they were right. By early 2025, Meta stock had rebounded dramatically, rising by over 700% to more than $700 per share. This kind of rebound is exactly what Howard Marks is talking about. While everyone else was panicking and selling, the smartest investors were carefully stepping in to buy. So how can you actually use this lesson in your own investing? Here's a simple, practical, 3-step framework to avoid getting swept up in market emotion. First, pause. When you see prices moving fast and everyone around you is either super excited or panicking, step back and pause. Give yourself some breathing room. The market isn't going anywhere, so there's no need to rush. Second, ask. Ask yourself one simple question. Is there real value here, or am I just caught up in the noise? In other words, do you truly think the company is worth buying at this price, or are you just following the herd? Third, act. Only act once you've answered that question calmly. If your decision still makes sense after the hype or fear has quieted down, you'll be far better off than those who jump in or out on impulse. It sounds simple, yet most investors never do it. They get swept up in emotion, buying at peaks and selling at lows. But if you remember Marx's advice, to pause, ask tough questions, and act with a clear mind, you'll consistently make better decisions and avoid costly mistakes. And that's exactly what being a smart contrarian is all about. Marx wants you to know that the key to investing success is managing your emotions. If you can step back, stay calm, and do the opposite of what everyone else is doing, you'll set yourself apart from the crowd. But here's the thing. Being a contrarian doesn't mean blindly doing the opposite for the sake of it. It's more nuanced. In the next part of this video, Marx explains how to become a thoughtful contrarian investor.
Just because 5 other people won't stand in the path of an oncoming freight train doesn't mean you should. So blindly just doing the opposite of what everybody else does is not a good tactic. But observing the behavior of others, figuring out what's wrong with it, and maybe doing the opposite is warranted at certain points.
Let's break down exactly what Howard Marks means here, because this is a crucial investing point that often gets misunderstood. Marx is saying that being contrarian doesn't mean blindly doing the opposite of everyone else just to be different. In fact, that can be risky, even reckless. It's like buying a house in a neighborhood no one seems to like. Sometimes it's simply misunderstood. Maybe it's quiet, safe, and has a new development coming that will boost prices. In that case, ignoring the crowd can be smart. But if people are avoiding the area because of real problems, like job losses, rising crime, or bad schools, buying there could leave you stuck with a home you can't sell, no matter how cheap it looked. The same logic applies to investing. Take Beyond Meat as an example. In 2021, it was one of the hottest stocks. It makes plant-based meat products, and many thought it was the future of food. Celebrities backed it, supermarkets stocked it, and investors jumped in. At its peak, Beyond Meat stock hit nearly $235. But in 2022, the hype disappeared, and the stock crashed to about $28, an 80% drop. Some investors saw that huge drop and thought it was a buying opportunity, just like Meta's crash and rebound. But Beyond Meat wasn't like Meta. Unlike Meta, Beyond Meat faced real, lasting problems. Its core product wasn't catching on beyond the initial hype. Supermarkets and restaurants weren't reordering as much, and the company was burning through cash. The low price wasn't just panic, it reflected deeper issues. Anyone who ignored those issues and bought just because the stock seemed cheap paid a heavy price. In May 2025, Beyond Meat stock had dropped even further, down to less than $3, a 90% loss from that supposed bargain price in August 2022. That's exactly what Howard Marks warns about. Being a contrarian doesn't just mean buying anything that's cheap or unpopular. It means carefully looking at the crowd's behavior and figuring out whether they're panicking for good reason or simply overreacting. Here's a simple question you can ask yourself. Is the crowd's fear based on real, lasting problems, or is it just short-term noise? Smart, contrarian investors look at situations like Meta in 2022, where the market overreacted and pushed prices far below what the business was worth. That's totally different from Beyond Meat, where the market's fears turned out to be spot on. Marx and his firm, Oaktree Capital, have always taken this careful approach. They don't buy just because everyone else is selling. They step in only when there's a genuine gap between a company's real long-term value and its current price. So remember, being contrarian isn't about always doing the opposite. It's about knowing when the crowd is genuinely wrong and also when it's actually right.
I was talking to my son during the process, and he's a professional investor also. He's a venture capitalist. And I said to him, Andrew, I think that my market calls have been essentially correct. So he says to me, yeah, Dad, that's because you did it 5 times in 50 years. And it's a very, very pregnant statement. 5 times, now I've been doing this 56 years. 5 times I found occasions when the market was insanely high or insanely low. And when it is, the logic, the analysis is compelling, and the probability of being correct is high. And I was right those times.
Howard Marks is giving us a key insight about how the best investors think about market cycles and timing. Instead of constantly trying to predict when markets will rise or fall, which is almost impossible to do consistently, the smartest investors wait for those rare moments when things are clearly out of balance. Imagine standing by the beach. When the tide is just a little higher or lower, you barely notice it. But when there's a massive wave crashing in or a huge wave pulling away, you know straight away. Markets are the same way. It's easy to see when prices are way too high or way too low, just like spotting huge changes in the tide. This idea doesn't just apply to the market as a whole. It also applies to individual stocks. It's hard to say if a stock is slightly overpriced or a little undervalued because there's always uncertainty. But when something is wildly expensive or extremely cheap, that's when great investors like Howard Marks really pay attention. Super investor Monish Pabrai calls these extreme situations anomalies, opportunities that are so obvious because their prices have swung far away from reality. Pabrai says these anomalies are really the only investments worth making, precisely because they're so clearly mispriced. This aligns perfectly with what Marks says about market timing. Marks openly admits that he's only made significant market calls 5 times in his 50-year investing career. He doesn't waste time guessing if the market will rise or fall next week or next month, because that's just a coin toss. Instead, he waits until the odds are clearly in his favor. He looks for those rare times when the market is gripped by irrational excitement or panic, creating clear opportunities. Most great investors do the same. They don't waste energy predicting every tiny market move. Instead, they focus on individual stocks that look attractive now, regardless of whether the overall market is high or low. Even when markets are booming, careful investors can still find hidden bargains. And even when markets crash, there will still be overpriced stocks. So remember this. The best investors aren't trying to time every twist and turn. They're patient. They wait until the market is clearly too expensive or too cheap. Those rare, obvious moments give you the best chance of making smart investing decisions.
How do you reconcile, in particular, the efficient market hypothesis with the real world? The efficient market hypothesis says that because everybody's trying so hard to find value and everybody's intelligent, computerized, numerate, highly incentivized, etc., objective and rational, prices converge with value. Everything sells for the price it should sell for. There are no bargains, there are no overpricings, and as a consequence, active management doesn't help because you can't find better or worse investments. They're all just fair. They're all offered at a fair risk-adjusted return. My answer is that the concerted efforts of all these investors cause people to incorporate information promptly to produce a price for every asset, but it doesn't have to be right. And because of the foibles of human nature, which I discussed earlier, motion and greed and fear and all those things, it's often wrong. But because of the human condition, it's very hard for any one person to improve upon those judgments. So there are often errors, but they're hard to find. That's my version of the efficient. The efficient market hypothesis, the prices are always right. I say they're often wrong, but it's hard to find the errors. And that's what I believe. Mm-hmm. And but there are more efficient and less efficient markets in the world. And so one of the ramifications for me is that we should only work in the less efficient markets where it's occasionally possible to find a bargain.
Let's unpack exactly what Howard Marks is telling us here, because this idea is crucial for getting great investing returns. Marks starts by talking about something called the efficient market hypothesis, or EMH. Don't worry if that sounds complicated, it's actually simple. EMH is the academic idea that stock prices always reflect exactly what companies are worth. The theory goes that so many smart people are always analyzing every detail, there are no real bargains. Everything is already priced perfectly. But here's the catch. If EMH were true, investors like Warren Buffett, Charlie Munger, and Howard Marks wouldn't be billionaires. These legendary investors have spent decades finding bargains that, according to EMH, should not exist. Marks says the stock market does a good job of quickly incorporating new information into prices, but he also believes it makes mistakes, because investors are still human, and humans often act irrationally, driven by emotion, greed, and fear. It's like using GPS to get across town. Most of the time it works great because it constantly updates based on data from thousands of drivers. But sometimes even GPS gets it wrong, like when a sudden accident or storm creates a traffic jam no one expected. Investing is exactly like that. We have tons of data and plenty of experts, but human emotions can still lead the market astray and create opportunities that data alone cannot see. Marks also points out that it's usually harder, but not impossible, to find these pricing errors in big, popular markets. Remember earlier when we talked about Meta? Even in massive tech stocks, there are moments when panic sets in and real bargains show up. But Mark says you'll have better chances looking in smaller, quieter markets, places with fewer investors and less attention. Peter Lynch, another legendary investor, said something similar in his book, One Up on Wall Street. Lynch argued that individual investors like you and me actually have an advantage because we notice small businesses and trends in our daily lives long before Wall Street does. Here's a great example from one of our team members at Investor Center. He's based in London and has been a loyal Hotel Chocolat customer for years. Hotel Chocolat is a premium chocolate brand popular in the UK. In 2022, the stock price crashed from £5.24 to just £1.10 after a small joint venture in Japan went wrong. But that Japan business was only 3% of their revenue. Most didn't realize the core UK business was still strong. Even more interesting, Hotel Chocolat didn't trade on the main London exchange. It was listed on AIM, a smaller market with fewer analysts and investors. That meant fewer eyes watching closely, creating more chances for mispricing. Because our team member knew Hotel Chocolat well, he'd seen the busy stores and loved the products, he realized the market was overreacting. While others ignored the company, he bought shares at those low prices. A few months later, chocolate giant Mars saw the same opportunity and bought the entire company for £3.75 per share, more than triple what he paid. That's exactly the point Marks is making. You have an advantage when you look in areas the big funds ignore, especially if you combine it with personal insights and careful research. Marks also strongly believes in sticking to your circle of competence. That means focusing on businesses and industries you truly understand. For example, Marks himself avoids high-tech or AI because he doesn't fully understand those areas. It's a powerful lesson. Stick to what you know best, because that's where you're most likely to spot opportunities others miss. So here's a simple rule to remember. Stock prices usually get close to the truth, but not always. If you focus on less efficient markets, stick to what you know best, and keep your eyes open, you'll have a much better chance of finding those rare opportunities. Howard Marks's disciplined approach to managing risk and staying contrarian is exactly how great investors build long-term wealth. But let's be real. Mastering these principles yourself, cutting through market noise, and keeping your emotions in check isn't easy. That's why we created Investor Center Research, a monthly stock research service built for investors who want to apply these proven principles with clarity, confidence, and less stress. Every month, we break down one carefully selected, mispriced company, using the frameworks of Marks, Buffett, and Munger, and show you exactly why it's worth your attention. You'll also see what we're buying, what we're holding, and why. Real insights, not just theory. We're launching soon with just 250 founding member spots. These members will lock in our lowest ever price for life. If you want early access to these limited spots, join the waitlist now. You'll get a 6-hour head start before we open to the public. And when you join today, we'll send you a free copy of our exclusive guide, the Ultimate Howard Marks Risk Management Guide. It distills Marks' most powerful lessons on risk into practical steps you can start using immediately. Click the link in the description, get your free guide, and secure your founding member spot today. I will see you over there.
This is gonna blow your mind. Subscribing could change the way you watch YouTube forever. Seriously, don't miss out. One click makes all the difference. Subscribing and smashing that like button isn't just for show. It tells YouTube you actually want to see more of my videos. If you skip it, you might never see my content again. So don't let FOMO get you. Hit subscribe, like this video, and let's make sure you're always in the loop. Trust me, you won't want to miss what's coming next.